Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Sarah Hunt of Alpine Saxon Woods writing this: the totality of the data seems to have shifted, and that was a certainty last week. Sticking the soft landing now is being called into question. Sarah joins us now for more. Sarah, good morning to you.
Good morning.
What changed at 8:30 Eastern Time on Friday morning?
I think it started to change on Thursday, and Friday just confirmed the fact that the data was in fact getting weaker. Those ISM numbers were weak on the manufacturing side, and then you had a payrolls report that was much weaker than people expected. And there's been a lot of controversy on the payrolls report of how much of how easy is it to interpret the data and whether or not the birth-death model makes a lot of difference. And when the numbers were high, nobody worried. And now that the numbers are coming down, people are really starting to worry. And you start to hear that conversation again, like how strong was it really all year and how strong is employment? And I think that that's part of the problem that you're having, and it just reinforced the fact that you had weak ISM numbers.
Let's chop up the equity market. 7% move lower almost on small caps last week. Financials got battered on Friday. Tech's getting hammered this morning. Banks are down again. Is there anything about these moves that you want to pick up the pieces anywhere at all?
I think the place that most people are going to want to pick up the pieces is going to be technology, because I think you had a guest on earlier this morning that made the point that the small cap trade and the bank trade didn't make a lot of sense if you thought the economy was going to get weaker. So I would say that that also is true, and that was one of those what else can we buy trades, as opposed to we really need to be in these sectors right now. I think that some of what's happening in tech is just you haven't really had a correction in a long time. You had this market running right up from January to July, and then we did a complete U-turn. So I think that that's where people are going to want to be. To Dan Ives' point, I don't think it's the end of the world, but it certainly is a very fast correction and a very strong correction when people were not necessarily expecting this much drama. But you have so much that's happening on an unwind of the carry trade, to your point on the end. There's so many different mechanical pieces underneath that it's hard to parse them all out because they're not obvious. It's not one thing, like earnings were terrible. They weren't. They were okay. It's just a lot of different pieces.
But I wonder, even if tech is the trade, is some of that huge enthusiasm we had over AI, is that just done? In a market where you need to worry about whether the Fed is going to cut or not, can you really be so hopeful on giving those companies more time to let their AI plays play out?
Well, if you think about some of the parallels that the people have made to like the 2000s, right? You had a lot of companies in the 2000s that were selling to customers that didn't have any money. So they were financing their own customers. It was a whole different situation than what's happening right now. I think that AI is like dark fiber back then. People are putting in capacity because they're not sure exactly how they're going to use it, but they're pretty sure they're going to find a use for it. Is that as fast as people expect it to be? Probably not. Is it what people expect it to be? It never is. It always changes. So I don't think that that goes away. And the companies that are bankrolling spending on this have a ton of money. It's not like they're in trouble in any way, shape, or form. But the timing was always going to be, Wall Street's so quick, immediate. I need to know immediately what's going to happen. And that's not the way it's playing out. And I think that that's part of what you're seeing here as well.
But even so, when you do see these stocks swing to the upside, the moves are huge. I mean, you get, again, $100 billion plus moves on the upside or on the downside for just a single name like NVIDIA. Does that make it harder just to stomach, to hold on to the ride?
It's one of the reasons why you're not supposed to look at your portfolio every day, right? But we do anyway, because that's what we do for a living. And I think the problem is just you had the law of large numbers with a lot of these tech companies. The earnings moved so fast for NVIDIA in particular because people were scooping up those chips and they were being able to charge higher prices for them. So then the question becomes, okay, when things settle down, what kind of pricing can they get? And AMD all of a sudden is now becoming a player, which people thought that they would be, but that didn't seem to be. And then all of a sudden their earnings were good and they were like, yes, look out for us. So there's a lot of moving parts. And yes, those things swing around a lot.
Let's just sit on the Fed just for a moment.
Sure.
We'll catch up with Ed Al-Husseini a little bit later this hour. He draws the distinction between a Fed cutting to become less restrictive and a Fed cutting to become accommodative. And I'm trying to work out where we're going to be in September. Are we cutting to normalize, or are we cutting to address a growth shock? Because they're two very different things, and I just wonder how different your capital allocation decisions would be based on what kind of decision we actually get in September.
Well, that's part of the U-turn, right? And that's part of, if the Fed had cut last week, which I would argue that they should have at least 25 basis points, then I think the amplitude of this would have been lower. You still would have had a directional downtrend, but I don't know if the amplitude would have been so high. And I think part of the problem is that's what they were moving towards, which is cutting to normalize. And now the growth scare is making that shift to maybe they're cutting because they have to. And that's where the 50 basis points, I think, is a push, because I don't think that they want to look that worried about it in September. But I think that if there really is a growth scare, I mean, we've been trying to position for slower growth anyway. So it's not like that's going to change our allocation too much. But in the end, this quick turn from markets and perception and investors from it's all fine and we still have growth to, oh my God, the world is coming to an end, is really made all of the markets come down. And I mean, everything is coming down right now. So I think I don't think people were expecting the amplitude of that change.
Okay, so I'll put it another way. Are these rate cuts worth buying, or rate cuts I should sell?
Oh, that's a tough one too, because I mean, I think that the question about, I was thinking about this in the green room, the question about rate cuts and what happens with rates when people are piling into treasuries as a safety trade, it stops becoming about rates and it starts becoming about safety. So it almost doesn't matter in the near term because people are piling into treasuries because that's someplace to put money. And I don't know when that flips back to, no, we really care about what the Fed's doing, and that's why I'm buying bonds, to I need to buy bonds because they're safe.
You mentioned what would happen if we got a 50 basis point cut. Sarah, if the Fed does do what this market is saying, an inter-meeting Fed cut, what would the reaction be?
I think, unfortunately, because they missed the opportunity last week, the reaction to a inter-meeting cut would be, what are they seeing that we don't see? And I think that's what they don't want to do, right? That's what markets don't want to have, is that kind of, 2 weeks ago everything was fine, or a week ago everything was fine, and now you feel like you have to come and intervene, when 25 basis points, to be fair, is not a huge cut. It's just that people were worried that if they went 25, they would expect that they would keep going. And I don't, that kind of concern I don't really understand. I think the Fed has more power than that, but they seem to get trapped into perception, and I think that that's part of the issue.
I just want to make sure I walk away with the right impression of where you're at currently. Do you think the pendulum swung too far in the other direction now?
Absolutely. But I don't know, but it doesn't...
More so in stocks or in bonds?
Both right now, because the bond is a panic, where am I going to put my money? And the stocks are, oh my goodness, the world is coming to an end. But the question is, did the whole Olympic stick the landing thing, when does that knife stick? And does it keep falling? And I don't know, because things always move too far. And there have been a lot of really levered trades that are underneath all of this, the yen, everything else, that are unwinding that we can't see. And that's where it's hard to figure out, where does that stop? I think that this is an overreaction, but I don't know when that overreaction stops, because I don't think that the underneath is as bad as it has been in the last couple of times the market's really had problems.
I'm just trying to work out where we actually really are at the moment. And we'd asked this question a few times over the last few weeks coming into that unemployment report. If we triggered the Sahm rule, and Claudia Sahm's going to have her own thoughts on her own rule a little bit later this morning, so you should look out for that. I said if we triggered it with this market behaviour as if we're in a recession already, even if the Fed policymakers and everyone else said we're not, would the market begin to behave like we're in a recession already? And this tees up, I think, the data a little bit later. Let's say we get ISM services and it comes in strong. Is that data that this market's going to ignore? Because it's so firmly fixated on the view that that's where we are now, a recession, and it embraces weakness and ignores strength. I'm just trying to work out how we respond to incoming information, how sensitive we are to strong data, how sensitive we are to weak data.
Well, I think this goes back to Danny's point. How much of this is underlying mechanical trading problems, and how much of this is a reaction to the data? It started as a reaction to data, and then it became its own problem. And that's, again, the problem of highly levered trades, is that when they go against you, the forced unwind is not necessarily things that people want to do, but it's things that people have to do. So the data can help slow that down, possibly, but it's not as much reactive to data as it is reactive to margin calls and to other issues that are underneath that on the financial side. So I think that the data would help, but bad data could make it worse. Good data might make it a little bit better, but I don't know how much that's going to stop this. This has to stop on its own, because there's some calming down of forced selling, and I feel like that's what we are that's where we are right now.
Forced buying of the Japanese yen as well, in particular. Sarah Hunt, thank you. Sarah Hunt of Alpine, Saxon Woods. Let's park all the price action and just sit on this. I know many of you have heard this phrase in the last few weeks. In fact, for the last few months, we've been talking about the so-called Sahm rule. The rise in the unemployment rate in July triggering the Sahm rule, a recession indicator for so many, which has a perfect track record over the past half century. Claudia Sahm herself of New Century Advisors saying this: I don't look at this and big picture say we are in recession, but I look at this and I say we're not headed in a good direction. Claudia joins us now for more. Claudia, you're famous if you weren't already. I think you know that anyway. It's great to catch up with you. I just want to take a beat and just sit on this for a moment. Claudia, let's go from the very beginning. Tell us what the Sahm rule is, what you wanted it to be used for, and whether you think it's applicable in a labour market like this one.
So the origin of the recession indicator was in a proposal I had to improve fiscal policy, put it on autopilot, automatic stabilizers in a recession. It's a rule in the sense of not the economy must do something. It was a rule in the sense of policymakers do something. It may end up playing out that way. So, but what the idea of it was to look at the historical record in the United States and find the pattern, find the unemployment rate increase. It's very important to look at changes at which, in the past, the U.S. has been in a recession, months into a recession. This is not a forecast, right? And so it's just trying to capture. And yet it is absolutely true that it doesn't have to be that way this time. And frankly, if we look at all of what we know about the U.S. economy, right now, it is very unlikely that we are in a recession. And yet a really important question is, where are we headed? And those changes in the unemployment rate that the Sahm rule picks up on, they do not look encouraging, right? They're headed in the wrong direction. And that momentum is what can get us in trouble.
So, Claudia, for just all of those people out there who are talking about your name, who are talking about the Sahm rule, using as an excuse to sell, using as an excuse to say that the Fed should be moving sooner. Just what do you say to those people?
Calm is important in a moment like this, regardless of what indicator or data point you're looking at. You know, the fear does no good. And this, again, this was trying to give a simple summary of one piece of the U.S. economy. The labor market is very important. There's a lot of complications right now. Again, it's this balance between be calm, but take it seriously. Right? Like, there is slowing in the U.S. economy, and we have seen that. The point is to keep that slowing from really pulling us in reverse. We're not there yet. Usually the Sahm rule, by the time it triggers, we're past that point, right? So there is this opportunity of, as I said, the Federal Reserve has a lot of place to ease. We do come into this in a position of strength, broadly speaking, in the economy. So that's really important for weathering a storm like this that has many different contributors to it today.
I didn't mean to use your pun as a segue, but I want to in terms of storm and weathering it, because on Friday there was just this huge debate when the numbers dropped of people saying, look, don't believe the numbers you're going to see because they will revert quickly, because a lot of it has to do with weather. A lot of it has to do with Hurricane Beryl. But by the way, the BLS comes out and says there's no discernible impact. Which side of this do you fall on, Claudia? Whether the numbers we saw on Friday are something that can somewhat reverse because it's a weather impact?
It's absolutely the case that any indicator, and the Sahm rule fits into this, should not be designed to overreact to 1 month of data, right? So the Sahm rule it smooths across months. The pattern it's responding to is a gradual steady increase in unemployment over the past year. Okay, so there's that. In terms of weather effects, the Bureau of Labor Statistics has the ability and the experience to look very carefully at the geographic data to get a sense of where its effects are. I think they take those statements very seriously, and I agree with them for a lot of reasons, including their statement, that the unemployment rate, specifically the Sahm rules on, was not affected. The labor force status was not affected. Being home being unable to work because of the weather doesn't flip you out of being employed to unemployed. So it gets really technical in that, but absolutely, that 1 month, that was a big surprise. It was a -1. A prior of just some of that will reverse is probably the right one. But it is the context of the year as a whole, and even moderate slowing and this increase in the unemployment rate has been in the past consistent with early in recession. So we might not be there, but we're getting uncomfortably close to that situation.
Claudia, you've worked at the Federal Reserve. You know better than most how that institution operates, how slowly it can move sometimes. How do you think it's going to respond to this data? Not just on Friday, but the data from Thursday as well, as we go into Jackson Hole.
On a day like today, when, as you said, the panic word is looming large for many people, the fact that the Federal Reserve is slow moving and deliberate, it's a good thing, right? The last thing we need is them joining into that that kind of that energy, that emotional energy, and yet they're watching it very carefully. The market functioning, liquidity, these are all the reason that we have the Fed is to make sure the markets keep functioning. Monetary policy then came later, right? So there is this aspect of them being diligent in terms of them looking at Friday's report and changing dramatically their views on a September rate change. I think that would be unlike them, and I think it would be premature, right? They're pointed in the right direction. They have some time to get there, but yes, they are slow moving, particularly when it comes to the economic data.
How do you imagine they'll frame that first interest rate cut? Do you think that's going to be framed as a mid-cycle adjustment, the process towards sort of normalization, or the first step towards taking a more accommodative stance, given what's developing? How do you think they're going to frame it, just given what we know so far?
Goodness, September feels like a lifetime away right now. I think if they can, the Fed likes to move on the path it's set out. The path it has set out is to begin normalizing interest rates because inflation is normalized, and we are in, kind of everything is planned in that right direction. I think they're going to want to keep to that narrative and to that path if they can. The last few days have called into question whether that is appropriate, will be appropriate at that point. And I will say one thing for the Fed, it is very deliberate. It can be very slow moving. But when the facts change and it gets its mind around it, it will move and it will do what it has to do. And we are in a position right now where they have the ability to do quite a bit, and that is notable.
And Jon made the point that both Citi and JP Morgan have changed their call now to see 2 consecutive 50 basis points cuts from the Fed. Claudia, what difference does it actually make, moving 25 or 50 in September?
It all fits within the context of that moment, right? If for someone changing to 50-point cuts, particularly consecutive ones, that's a pretty dire outlook for the economy when we get to that point, or intervening. That's not where my baseline is. I don't think that's where the Fed's is. I mean, looking at the data and where we're at, and yet. Clearly, if we were seeing large moves like that out of the gate, there's a real problem. But we saw some big moves out of the gate in fighting inflation in 2022 in the other direction, and the Fed will take its policy to where it needs to be to the conditions in the economy.
Claudia, we appreciate your time. Just fantastic to speak to you personally. Claudia Sahm there of New Century Advisors. Joining us now is Andrew Hollenhorst of Citi and Stephen Stanley of Santander. Gents, it's great to catch up with you both. I want to come to you first, Andrew, because you're out with the big call on Friday, 50 basis points in September. Goldman's is sticking with 25. They think maybe you should wait for payrolls to come out for August in September. Why are they wrong? Why is it now the right time to make the call? Why are you so convinced by Friday's data?
When we came out with the 50 basis point call for September, we also think they'll go 50 basis points again in November. That was just after the jobs report. And I think that the key thing in the jobs report is not that the unemployment rate rose to 4.3%. It's not 1 month of data. It's that we now have 4 consecutive months of the unemployment rate rising and accelerating. So if the Fed is trying to get a soft landing, you have a lot of momentum upwards in the unemployment rate that you need to stop. If you're trying to stop that kind of slowing momentum, that means rates should be down maybe at neutral, maybe below neutral. Well, where's neutral from here? Most people would say at least 200 basis points below where we are. So 50 basis points in September is really just getting started. That's why we have 50 again in November. Base case, they don't do this emergency cut, but it's possible.
Possible? What would make it happen?
I think a further sell-off in risk assets and seeing that broaden, right? It can't just be about the tech sector. It has to be broad. It has to be in credit markets, seeing credit spreads widening, liquidity issues. Those are the kind of things that could get the Fed to move early.
Stephen, you're skeptical of that they could go 50, that they're more likely to go 25. Why?
Yeah, I think, well, first of all, I mean, the key thing for the Fed right now is inflation. And I don't think that we've gotten over the hump on inflation yet. We had 4 bad numbers. We've had 2 good numbers. I mean, I did my forecast last month for CPI, and I got 0.3 for the core CPI. I don't think the Fed's going to be cutting dramatically in that sort of an environment. I also don't think the economy's that weak. I mean, Andrew's right about the unemployment rate, but if you look at the totality of the labor market data, it's certainly not signaling that the unemployment rate is giving us an accurate signal of what's going on in the labor market.
But again, as Andrew says, if it's not the level, it's the trend. Is the trend not concerning? Is that not enough for the Fed to step in?
Well, again, I mean, look, the household survey is a very noisy set of data. It's a very small sample. If we were seeing a dramatic pickup in jobless claims, if the JOLTS data were supportive, if all the other survey data that we were seeing was supportive of a dramatic cut in or a dramatic weakening in the labor market, I'd be more convinced. But as it is, I see that as more, there's a lot of noise in that number in my view.
I want to pick up on your point on inflation. I think it's really important, and it's hardly been talked about for the last few days. We've got the next print on August 14th. Peter Chi of Academy published this over the weekend, and he said if the Fed does anything that looks or smells like they are eager to embrace the Fed put, we would likely see inflation, starting with risk assets. They're caught between a rock and a hard place in terms of being able to be aggressive. Why do you disagree with that, Andrew? Why do you think they're not as constrained as perhaps Stephen and the likes of Peter Chi are suggesting?
There are medium-term concerns about inflation. I'm not discounting that at all. But in terms of the near term, you have financial conditions that are tightening right now, are tightening rapidly, even as we sit here. And if the Fed doesn't push against that tightening in financial conditions, you will actually end up slowing the U.S. economy by more. So what they're dealing with right now is risk management, where, yes, there's some concerns about inflation, but cutting rates now, if they cut 50 basis points in September, that's already priced into the market. That's not going to cause equity prices to rally. They need to over-deliver on what's priced at this point to get equity prices just to stop selling off.
This is where I'm a little bit confused. It was only a few months ago we had people asking whether we needed to hike again. How much of a clear sort of sight have you got on how tight we actually are right now? How do we know that we're as restrictive as you are making out we are?
I think the clearest evidence is from the labor market. That's been our guiding light throughout this cycle and continues to be. If you look at the JOLTS report, for instance, the hiring rate has just consistently been falling below pre-pandemic rates, falling now. If you look at the leisure and hospitality sector in the JOLTS survey, the hiring rate is the lowest we've ever seen outside of 2008. It's lower than it was in 2020. So it is harder to get a job at a restaurant right now than it's been in very deep recessions. That's telling us that we have some real softness there.
Check out this move in the bond market. We've been talking about it for a while. 2-year versus 10-year. The 2-year is down 23 basis points. The 10-year is down just 12. And look at the difference between the two. There is a positive sloping difference now on that yield curve. Danny, I haven't been able to say that for quite a while.
No.
The difference between the two is now positive a single basis point.
And there have been so many people who have said that when this happens, this is the recession indicator, not the thing being negative, not it being inverted, that it's uninverting that finally causes the recession. Steve, do you want to take any indication from this at all?
I'd like to let the dust settle a little bit. Today seems like not a good day to be taking your fundamental signals. No, I think to Jonathan's point before, I mean, what we really need right now is we need more data. And we do get the ISM non-manufacturing today. The consensus looks for it to bounce above 50. Boy, that would, I would imagine, change the way people were thinking at least a little bit.
Do you think it would put this story to bed? Because we said one of the problems with this week is that actually the calendar for the economic data is quite light. We've only really got 2 points to play with. One is the ISM at 10 and the other is jobless claims on Thursday. Is one strong ISM services print sufficient to put this to bed? Or do you think the mood this market's in will just ignore strength and embrace weakness for the rest of this month?
Seems like an awfully strong panic mode this morning, so I don't know. Maybe. We'll see.
Andrew, this is tough, and I think this is what everyone's got to sort of embrace and confront right now through the next couple of hours and through this week. How sensitive this market will be to incoming data, strong data, and weak data alike.
It's a really difficult moment. It's a really difficult moment for the Fed. Danny said it earlier. You have the market that started responding to the economy. Now you're going to have the economy that's responding to the market. As these financial conditions tighten, it actually raises further the probability that we're in a recession right now or that we'll soon be in a recession.
Could we get an intermeeting cut then if this thing kind of snowballs?
That's the question. I think you do need to see more here. I don't think this is enough for an intermeeting cut, but that has to be something we put some probability on at this point.
Stephen, any probability of that for you?
Not unless the world absolutely falls apart.
You're not impressed by these calls at all, are you? You really think this is just a panic that could be over pretty quickly? That's what it sounds like. Is that a fair sort of characterization?
Yeah. Yeah, I mean, look, the Fed is going to be easing soon. In my mind, more likely than not now September rather than November. But and I think once they start to go, they're probably going to be going in a series of moves. But I just don't see the need for a kind of a panicked rush.
Would they still call this a mid-cycle adjustment, do you think? Or would they tell us they're on the path to normalising, on the path to getting accommodative?
I think it's a path to normalization, but whether that leads ultimately to accommodative or not, I think remains to be seen.
Andrew, how do you think they'll frame things?
I think I agree with Stephen there that they will see this as the need to normalize policy rates. At least that will be the first move here. Now, it might move to a need to move to accommodative. We've heard from Chair Powell, they think rates are restrictive here. And I guess that's my broader point this morning. Why would you be restrictive when the equity market is selling off and the unemployment rate is rising? You wouldn't be, so they'll be looking pretty quickly to move rates down towards at least 3%.
But if we want to live with the philosophy, if the Fed should do the least damage in this scenario, is hiking aggressively or before September not doing damage in terms of them signaling we're worried about something, that there is an emergency?
Yeah, I think that's exactly what they need to negotiate here. And I think you heard that tension from Chicago Fed President Goolsbee on Friday, not wanting to sound like they're over-responding, not wanting to spook the market further. But the reality is the sentiment is shifting, and it has shifted, and they'll have to respond to that.
But see, Stephen, that's why I wondered, to your point, why there can't be something bigger, because it feeds back on itself, and you get that negative wealth effect. You get conditions tightening, maybe more than they should, which gets a bigger reaction from the Fed.
Yeah, well, I mean, this has been one of the problems for the Fed all through this cycle, is that financial conditions have been easy, right? I mean, they raise rates, they talk about how policy is restrictive, but if you look at broader financial conditions indices, they've all been very easy up until, the last few days, and now we have to weigh, deterioration in risk assets versus the big rally that we're seeing in interest rates. So I think they're certainly cognizant of that, but I think the underpinnings for the economy are still pretty solid. And the one problem that this economy has, conceivably, is that Fed policy is super tight, and that's something that's very easy to fix. So we'll just see whether that comes fast or slow.
As of last week, Chairman Powell agreed with you. I just wonder how much has changed since Friday. Andrew, do you think if they had that information to hand on Wednesday, we would have seen a different decision?
Yeah, I think we would have seen a cut on Wednesday if they knew this was going to be the jobs report.
Amazing. Andrew, thank you, sir. Andrew Hollenhorst of Citi, Stephen Stanley of Santander. To the two of you, thank you.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.